Welcome to the Executive Real Estate Investing Show. This podcast is for you, the busy business owner or executive looking to create generational wealth. Here, we're going to show you how to do that through real estate investing, from multifamily to industrial and everything in between. You will become a real estate investing expert. And now, here's your host, Michael Holman.
Hello, everyone, and welcome to another episode of the Executive Real Estate Investing Show. I'm your host, Michael Holman, and it is great to have you with us this week. Like always, we are going to start today with the executive tip. And today's executive tip is, no matter where you are or what your business or who you're communicating with, you almost certainly can benefit from an increased knowledge of the internet, right? And digital marketing. And this is something that we actually get into in this podcast right at the very end with Jerome Myers. And it is phenomenal. But if you don't already have a digital marketing presence, or you don't even know where to begin, I would highly recommend it is time. The internet is a vast pool of potential partners, clients, relationships that you need to know and understand. So get into that. Also, right before we get into this interview with Jerome, which was fantastic, by the way, please, if you are listening to this on Apple Podcasts, Spotify, Stitcher, wherever you're listening to it, go ahead and hit that subscribe button if you like what you hear. We would love to get your feedback as well. Not only hit subscribe, please go in, leave a rating, leave a review. We want to hear from you. And lastly, go out and check out the Executive Real Estate Investing Show website. That's executivereishow.com. All the episodes there, lots of resources and more that gets continually added each and every week. Now let's get into this interview with Jerome. Hello, everyone, and welcome back to another episode of the Executive Real Estate Investing Show. As always, I'm your host, Michael Holman, and we have a very special guest with us here today. His name is Jerome Myers. He's been all over the place. If you're on LinkedIn, you've probably seen Jerome. He's the one that has the shirt that says, "I took the red pill," and he's wearing it right now. And I'm about to ask him about that right now. But Jerome, welcome to the show.
Michael, thanks for having me, man. Super excited to be with you today.
Awesome. And it's exciting to have you here with us. Just a little bit about Jerome. He's the founder of Myers Methods. He's also the host of the podcast Multifamily Missteps, and he's a multifamily operator operating out of Greensboro, North Carolina. But to get right into things, if you're listening to the show and you're not watching, you don't see that Jerome right now has on a shirt that says, "I took the red pill." And right before we started recording, I had to ask him, what does that mean? But Jerome, I'd love to hear. Tell our listeners, what does it mean when you have this shirt saying, "I took the red pill"?
Yeah, you're making a proclamation that you are living outside of the matrix. I think so many of us get trapped in this whirlwind of activity. It's called busy, and we lose focus on the things that are really important, right? I have created a model for a centered life. I think there's a bunch of coaches. Everybody's a coach these days, right? And there's people who can teach you how to raise money, and people who can tell you how to make money, and people who can teach you how to buy a deal. And I'm the guy that wants you to live a centered life. I want you to be able to show up as you are, regardless of the room that you're in, because the person that you've grown into is somebody that you're proud of and people can identify with. And so our model has 6 levels, the red pill. It's self-image, relationship, work, health, prosperity, and significance. The first 3 are the source of all your stress: your image, your self-image, your relationship, and your work. And so people are like, wait, what do you mean? Okay. So if you can't keep promises to yourself, you become really frantic and stressed out, right? And so we help people get really clear about who they are, what they do, and being accountable to self, I think, is the key to everything else in your world becoming available to you, unlocked. And so then we move up to the next level, which is relationships. So the people who are your listeners are more likely, right, business owners. They're leading the charge. And so the folks who are around them come to them for answers. Very few are just really interested in, hey, how are you doing today? Is there anything I can do to help you? It's always, hey, I need this, I want that. And so when you are in a bunch of those relationships, you get depleted pretty quickly because there's nobody filling your cup. And so we work to reframe or reposition those relationships so that there's mutual benefit. You're not just giving all the time. Instead, you're able to receive. And then we go to the next level, which is the work, right? And so if you have great relationships, then usually your influence and your sphere of influence grows, right? Because people know that they can count on you to get things done. That usually grows your comp and allows you to live out your morals and values. Well, if we can get all the three of those things, their self-image, relationship, and work taken care of, you stop doing the self-destructive habits that you use. And the words that you use in order to justify it is, oh, I just need to take the edge off. I need to relax. I need to cool off. I need to just
I hear those
find
words all
some
the time.
solace. Yeah, right. And so you're usually not doing something that's good for you when you say that. And it's because life is raw, it's intense for you. And so if we can reduce your stress level, then you don't need to take the edge off. And so that allows us to move into health and get your meditation or your morning routine practice going and getting you in a space and a place where you're performing at peak levels because, well, you're treating your body and your mental health well. And then we move to prosperity because we think everybody should have abundance, and out of your abundance you can give, right? Your overflow, you're able to share that with other people through your significance play. And so we run through those 6 areas and really help people hone in and tweak and dial those different areas depending on where they are, so that when they show up in life, they're showing up as an apex performer.
That is awesome, Jerome. And there's a lot of good things in there. I mean, my goodness, we could almost spend an entire show on each one of those. But as you were talking, I took a few notes, and I wanted to go back and ask you about some of these things. So when we were talking about relationships, right? And we're talking about, hey, a lot of times, because you're right, a lot of the listeners, they're business owners, there's business executives, or they're people who are aspiring to be that. And people are coming to them all the time for answers. I mean, I'm sure I've experienced this, right? I mean, we were just talking earlier about my morning, where Monday mornings sometimes just feel like I'm putting out fires because of all the stuff that happened over the weekend, when I was trying not to work. And so how do you, I mean, for these people who have this influence that a lot of it is expected out of them, how are you managing, or what advice do you have for those people to kind of turn those relationships so that they become a two-way relationship, and just instead of always giving?
Well, the giving is fine, right? Giving is fine as long as you have something to give from, right? When you think about, I just got off a plane, right? And so when they give the safety brief, they tell you to put your mask on first and then help other people.
Mm-hmm.
And that's where we lose it, right? If we're not connected to source, if we don't have somebody filling our oxygen, then we'll very quickly run out of supply.
Mm-hmm.
And when we run out of supply, then we usually go try to get our legitimate needs filled in illegitimate places. And when we make that choice, we usually blow the whole thing up. So you can build your whole life building a reputation, a brand, and a couple of poor choices can put you in a place where you lose it all because you didn't set up the systems, you didn't create the relationships where the thing happened for you prior to you going and getting it from a place that you shouldn't have got it from.
That's really insightful. And correct me if I'm wrong here, but as I kind of look like I'm kind of reading in between the lines, it almost sounds like it's not necessarily every single relationship that you have has to be, I give and then you fill my cup. It's not that every relationship doesn't have to be like that. They can be two separate relationships, right? You can have one relationship that helps fill your cup, because just by default, right? I mean, I look at some of the employees that I have, it's not like they're capable of stepping in and doing some of the things that I just have to take care of, right? And they can't fill my cup in that manner. But there's other ways that I can fill my cup in other relationships that don't necessarily have to be, you have to give me as much as I give you, period. And that's how every single relationship has to be. Is that what you're saying?
Right. I don't believe, well, partially. So I don't believe everybody has to give the same amount in every relationship. I do believe that a relationship is inherently unhealthy if there isn't give and take in each relationship, right? Because it becomes parasitic,
Yep.
right? They're only there to take. And once somebody gets to the place where they're only there to take, you have a loss of respect. There's a loss of gratitude. There are some unhealthy things that are always going to fall out of that. And so we want everybody to be a contributor to the relationship in the way that they can. And everybody can't be everything for you. So I think it's important to realize, hey, this person has this capacity, and allow them to show up for you in that capacity. And if you need something else, then make sure that you're going to the appropriate source for that. So yes, I agree with you in concept, and just with those small nuances.
Yeah, no, that's really insightful. Right. And I mean, and the way that you phrase that is perfect, because I mean, right, cup gets filled, right? Like my family, right, or my wife, she fills my cup in a way that, some of my employees are never going to be able to do, right? And so, and vice versa, right? I mean, I can't go to my wife and ask her to do some of the things that I would ask my employees to do. I've tried that. It doesn't work that well. Right. But I love what you say about every single relationship. Somebody has something to contribute to a relationship. And I think that's a great mindset shift for a lot of people, because I think especially when you're a VP or you're a boss or you're an owner, right? It kind of the mantle, the burden gets placed on you to give everything all the time, right? I mean, it's your expectation. And I think there's really healthy ways, like you were mentioning, that you can bring everybody's best self to the table and contribute to every relationship in some form or fashion. That was phenomenal. Really, really good stuff. Well, one of the things too that I kind of wanted to dive in as well, along with the relationships, you'd mentioned your routine, your morning routine. That's a question that we get a lot, right? What routine do I need to have, or what are successful people doing? I have my personal routine, right? I mean, I actually just went a couple of weeks ago, I was on Whitney Sewell's podcast, and that's something that he was asking me about, right? What's your morning routine? And I went through that there. But Jerome, I'd love to hear what's your morning routine?
So it's out of control, first of all, Michael. I don't want anybody to think that they need to do what I do, right? But it looks something like this. So wake before 5 o'clock. We start with a 30-minute meditation. And then we do 30 minutes of reading, actual physical book, not listening to it on audio. There's something about the discipline of turning the pages and being able to write in the margins that I think we lose when we multitask by washing dishes and reading by
Yep.
listening to an audio book. And so just the discipline of sitting still and consuming the content. And then from there, we do a little bit of Spanish on Duolingo. And then we'll go out for a 60-minute run. And sometimes we mix in 30 minutes or so of weights in addition to that. Then we get back and we do some audio learning, podcast, book, whatever it may be. And then we get into journaling. And then we think we're ready for the day at that point.
That is awesome. Well, if you want like the quintessential, the ideal morning routine, it probably looks something about like that. But that being said, it's different for every person, right?
Yes.
But if you were just to put it on paper as, hey, here's the standard routine, that's awesome. But yeah, like you mentioned, and like I'm saying right now, it is different and it's tailored to every person. Now, obviously not every morning can be exactly the same. Jerome, what aspects of your morning routine do you feel like there's maybe one or two things that are the most important for you personally, or is the entire routine kind of all or nothing for you?
I think The most important piece for me is the meditation or the silence, right? The ability to organize and process the thoughts and put them in the different compartments so that you can
Mm-hmm.
actually focus on the task in hand is a game changer. I think most people just want to do, busy, 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 but that's not smooth and it ends up being really choppy and
Mm-hmm.
fragmented. And so you don't actually ever end up in flow state. It's my goal to get in the flow state so that it doesn't feel like I'm working, but it's just coming through me. And
Perfect.
then we produce the art.
Well, and I love what you're saying with flow state. And correct me if I'm wrong. I believe that I've heard that phrase a few different times. What do you mean by flow state?
So with flow state, time slows down and the pattern you're able to recognize patterns. The and your ability to recognize the pattern gets you to the outcome quicker. I think a lot of folks are looking for a hack, right? They want to do this or do that. Those things don't usually work because you don't understand the frame where that strategy or that tactic is applicable across. And so you're trying to apply this hack in a situation where it doesn't matter. If, I think the majority of your listeners have some concept of what it takes to model a business plan, right? A
Mm-hmm.
project. And in that, you're making assumptions. You got a cap rate assumption, interest rate assumption. And if those assumptions are wrong, then what you project happening on the back end is not going to actually be true. And I mean, I know that the model's going to be wrong. It's just a matter of whether you're high or low on your model. But the important piece here is understanding that, hey, this is the trend. If I apply this with that trend, then I can predict the future. You end up in a really good spot. But if you don't understand the trend and you just do the strategy
Yep.
and say the trend's going in the wrong direction, or you apply the strategy and incorrectly, then you're going to blow up something that you thought was a slam dunk. And where we are in the market, for if we just want to dive into the real estate at this point,
Yeah.
I think there are a lot of people who are making faulty assumptions, and those assumptions are going to lose people's money.
That, I want to get into that right now. I just have one quick mention that I have to say. You were talking about the hacks versus the actual template or the model. And it kind of makes me laugh. It goes back to an experience that I had. I remember I first read The 7 Habits of Highly Effective People in college. And at the time, I was just looking for those 7 hacks, right? What are like the 7 tips that is like, hey, I just have to do this checklist every single day and I'm going to be amazing, right? And I started reading the book and I went through the whole book. I almost hate to say it, I didn't like it. I hated the book the first time I read it because it wasn't the 7 hacks of highly effective people, right? I mean, right. And so all of a sudden, I went 6 or 7 years, and people always were asking me, "Hey, what book would you recommend?" It's like, oh, I don't really like that book. I went back and I read it again, and this time my frame of mind was completely different, right? I wasn't looking for the 7 hacks. I was looking for the 7 habits, the models, and it turns out that book was so good. It actually was turned into one of my favorite books because of the frame of mind and the frame of reference that I had. I actually read it twice in a row. I do this weird thing all the time when I find the book that I like, I end up reading it 2 times in a row just to try and capture as much as I can. But that was, that was my own experience. We're all looking for hacks and those things just don't work. And that got lined out so clearly for me that second time that I was reading The 7 Habits of Highly Effective People. It's like, hey, you need to change your mindset. You need to change who you are, not just what you do, and that kind of goes back to the modeling that you mentioned. But as we were getting into the real estate, and I was really excited. So you mentioned you feel like there's a lot of assumptions, a lot of things out there that might cause people some issues. What are those key assumptions that you're seeing, or that at least in your mind are kind of causing the red flags to go up?
Yeah, I don't think rents can just go up with no limit. I mean, And people are modeling it as if for the next 5 years it's going to happen. I just don't know how it's possible. And maybe it is, and I could be overly conservative, which I'm okay with because, I'm more concerned about preservation of capital than upside.
Yep.
But for the folks who are thinking they're going to double or triple folks' money over the next 5 years because they're going to be like the past 5, I don't think I think that's a false assumption.
Yeah.
And I think that counting on cap rate compression and rent increases greater than, 5%, I just don't know that their project is going to be saved.
Yep.
And it's terrifying because, we're in the middle of a development project and we don't know what to do right now because units that were going to cost us $120,000 are now being projected at $180,000.
Yep.
And, can we just adjust the rents and say, hey, this is what it costs and we'll get it? I can't say that, right? I need empirical data that proves that this is going to happen. And sure, it's 2 years out, but does that mean that we're actually going to be there? Again, preservation of capital is more important than upside for me. So I just want people to be really careful when they're placing their capital and making sure that they're going in the deals where their cost basis makes sense and they have a business plan that's actually executable. I think you have to have both in order to make money in multifamily.
That is, I if you can't see my face because you're watching, I got nothing but big smiles because Jerome, you're talking my language right now. As a developer, we do a lot of multifamily. This is the world and the realm that I live in each and every day. And I think you're exactly right. I've seen some of these projects where you have people who are trying to develop it. And all of a sudden they're trying to project, 30% rent growth in an area over like 2 years. And you're like, what in the world? And if you tone that down to 3 to 5%, all of a sudden they're making like a 2% return kind of thing. So I have definitely seen this, and it brings up the same concerns for me, is that sometimes you just get people who get very aggressive, right? And that can be
It's
scary.
dangerous.
Yeah. And it's dangerous. And it's exactly just for the reason that you said. Especially on development, we dealt with that too. We just had a project that we're at the time we're speaking, we're just about to close on the construction loan within about a week. And we had that same problem. We first projected the cost out in December of 2019. We had multiple estimates. We knew we were right on. Well, by the time we go to start that project right now, costs have gone through the roof, right? Comparatively. And that project ended up costing almost $12 million more than we originally anticipated, which, how do you deal with that? And that's a big thing. And the only reason that we were able to make it through on that is because, hey, we were conservative. We had enough meat on the bones. For example, we validated it with appraisals, and that's kind of what you have to do in that scenario. So like I said, nothing but smiles for me right now, because everything you just said, that's my world. That's my realm.
Real life. Real operators, ladies and gentlemen. We're not just talking about it. We're actually doing business out here.
Yeah, no, I absolutely love it. So I'd love to hear, you kind of had mentioned a couple times, hey, preservation of capital is more important to me than returns, which is sometimes I feel like that kind of goes against the grain of some of the narratives that we hear, because especially over the last, 5 years at this point, and take the last 2 years, for example, where cap rates have gone nothing but down. And in some of these markets, you have rental increases of 20-25%, right? Everybody is looking, especially limited partner investors. They come into deals and it's like, how much can I make, right? Are you gonna triple, or are you gonna quadruple my money? Like, tell me which one it is. Why do you talk about and say, hey, capital preservation is actually for you more important than returns?
Yeah, I guess I've just been fortunate enough to be around some really wealthy people, and that's what they care about. They've made it. And so I don't care if you can give me a 30% IRR. That doesn't matter to me. what am I risking in order to get that?
Yep.
And they want a sure thing. And I've just come to the place where I think wealth is built on sure things. You might get rich taking big risks, right? And that's why people are doing Bitcoin and all the other cryptos. And it's like,
Yep.
oh, what is that based on? And how can I make sure that I'm accurately associating a premium for this investment based on the risk that I'm exposed to? And, people don't like development because the long time horizon and the market might not be proven or where you're going into and et cetera, or who's going to perform on the construction because construction is so hard and blah, 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 blah. Right.
Yeah.
All the folks that all the folks that I do deals with, they are interested in real estate because they know that the asset isn't going to go to zero.
Mm-hmm.
And there's going to be some salvage value if you totally screw the pooch. I've had money, I've had no money. And what I found is that when you're super aggressive, it's because you don't have any money and you're trying to get out of that place. But true wealth is built with very risk averse approaches that allow you to manage out as much of the risk as possible, right? I still remember being in corporate and some of the guys who were in our business group being upset because they wouldn't let us do this project or that project. And it was just like, we're not going to risk an enterprise because we think we can get a quick hit. Like we want to build something that's sustainable and we can see a very methodical approach to this outcome that we're pursuing. And so I've just been there. And I guess the last piece of it is, man, I'm a civil engineer. And one of my early projects, there was a tower on the side of a mountain holding electrical power lines. And we had to replace the legs of the tower. And so my job was to do the calculation of wind speed and so that we properly sized the crane to hold the tower while men were working there. And if I was wrong, and the crane didn't work, the crane could be pulled off the side of the mountain. The people at the floor could be crushed by the tower or electrocuted by the live power lines that were up above their head about 100 feet. And it was then that I realized, like, this is real life. And while, investing money isn't life or death, for some people, it's their life savings. And do I want to be the person who made an inappropriate assumption and didn't have enough safety factor and I put them in a place where now they can't retire? Not me, not on my watch. I want to make sure that people are able to live their life the way that they plan to, and that we did all that we could to eliminate unnecessary risk.
I love that, right? And I think that what you're saying and the experiences that you have, coming from a civil engineering background into multifamily operations, I think is spot on, right? I mean, it's really important. And the other thing that I love is that you're looking at it from an investor standpoint, right? Because as the sponsor, we try and align ourselves as much as possible with the investors, right? But our livelihood is getting deals done and doing deals and things like that. And I think what you just did, taking a moment to step back and saying, hey, look, like if I were this person, right, and my life savings was $1 million, and this person's asking me, hey, invest $500,000 with me, that's half of my life savings. I need to treat that money as if it were my life savings, the way that I would want someone, if I were to put my life savings with them, I'd want them to treat it, right? That's important for me. And I love the way that you kind of stepped into the shoes there to really be able to project yourself onto saying, hey, if I were an investor, these are the things that are important.
Yeah, I actually believe their money's more valuable than mine, Michael. I at the end of the day, the whole concept of, oh, we'll just do it with other people's money, and if it doesn't work, okay, doesn't sit well with me. I don't want those people to be in the game, right? Because they aren't actually fiduciaries,
Yep.
right? They are thinking about it like it's a tech startup and whoop-de-doo.
Yeah.
I don't see the world that way, brother. I think people should, while you can't guarantee anybody's investment, I think people should sleep well knowing that their money is with me in a deal that we are doing. I want people
So
to know that they're whole.
that's awesome. Well, one of the things I got to ask then, so Jerome, are you mostly syndicating your real estate projects?
No, in fact, we haven't syndicated any. Everything that we've done has been joint ventures.
Perfect. Well, I'm really interested in getting into that in a little bit because yeah, you hear a lot of these people, and we've, on our end, we've done both institutional money and we've done syndications and joint ventures, right? We've done all three of those. And they are a little bit different, right? I mean, you talk about, hey, this is just like a tech startup. And sometimes that happens in the institutional space. I mean, right now where we're based out of in Salt Lake City, there are a number of institutions coming in and basically throwing assumptions to the wind and saying like, hey, we don't care. We think this market's going to go up. We want to go, 80,000 a unit on our purchase price for land. No big deal. We don't care because we think it's going to go more than that. And some of those times you have those institutions come in and it does feel like house money if you're if your interests are aligned, right?
Yeah.
The complete
Yeah.
opposite can be true with an institution as well. Don't get me wrong. And so, what you're saying is really interesting. So talk to me, you mentioned JV. Can you kind of just maybe run through what are the differences between joint venture and a syndication deal?
Yeah, I think there's something called the Howey test, and the Howey test determines whether or not you are selling a security. There's the first three pieces of the test. The answer is always going to be yes. The last question is, are you relying on the efforts of a promoter to get the return? And if you answer yes to that, then you have a security.
Mm-hmm.
If the answer is no, then you potentially have a joint venture. And so what a joint venture means is everybody has an active role in the project. What that role is, I'm not an attorney. That's up to the people who are in the partnership. But what I can tell you is, it's not just having voting rights. You actually have to be engaged in a meaningful way. And so when we do these deals, part of the reason why we do the deals the way that we do is because I didn't know anybody who had a multi-million-dollar real estate portfolio. And so when I wanted to buy apartments when I was in college, I had a big problem. I didn't know anybody who was doing it. Right. And so me and my buddy Duran were sitting on the stoop and we did the math and we realized the guy that owned the complex was doing at least $700,000 a year top line. And we were like, but we don't need that. We just need 70. What do we do? Like, how do we get to this place? But we never saw him or talked to him because he had third-party property management in place and everything was being taken care of. He figured out the decoupling of time from money. And so when people syndicate, but they have a desire to be active, it's really hard to go from a wannabe syndicator to an actual sponsor because you usually don't have the net worth, you usually don't have the liquidity, and the folks who are leading these deals aren't going to just give that to you, right? And so there's some dues that have to be paid. It truly is a fraternity or sorority where somebody's got to bring you in. With the joint venture, you own more of the deal. Depending on the capacity of the partners, you can do really small deals or you can do multi-hundred unit deals depending on, just people's net worth and liquidity. And so what we look to do is bring at least one new person in to the joint venture, have them sign the loan so that they check the box for experience. And then in that program or in that situation, we can end up with opening the door for somebody who hadn't had that opportunity prior. Yeah. And for us, that's really important because we didn't have a path to that. And when I was smart enough to actually look at a lot of the syndication programs, I didn't believe the promise. No money, no experience, no capital, but you can buy a $10 million deal. The promise and the requirement didn't make sense for me. So I had to pull back and find another way where it actually made sense. And so I call it getting tuned in the boat. So I don't tell anybody to go buy a 100-unit building or build a 100-unit building their first go. I tell them to go buy something that's between 10 and 30 units. And for most markets, that's going to be between $500,000 and $1.5 million, something like that, right? And you can get together with a few of your buds. You can take down the property. You might need an experienced partner to come into that deal, but if it's smoking hot, there's a lot of people who are interested in it. You do that, you prove that you can make money, right? And then you go do another one, and you tell people about the one you made money on, and then you go do another one, and sequentially building your track record. And these are going to be the hardest deals you ever do, by the way, because the larger deals are easier. But you do these deals, these smaller deals, as an operator to cut your chops and really get an understanding of what the business is and how it works and how you pull the levers, because you got to figure out how to fly the plane, right? Yep. And then I think you're in a good place to go raise money from other people because you do have some operating experience. And everybody doesn't want that. They want the shortcut, and I'm okay with that. But I get really uncomfortable when you can't write a check to fix the problem that happens at your property, because there's going to be a problem at some point.
Yeah, I wholeheartedly agree. I mean, you have some that are better than others, but a lot of times you hear some of these gurus that kind of come up, and it's like, you can make $1 million a year and have tens of thousands of units, and you're not going to use any of your own money and this and that. And you can be flat broke as you get started. And it's kind of, I always am shaking my head because, we do a number of syndications. And to say that it requires none of your own money and no experience, and, those feel like pretty, dicey statements to me, because I can tell you, right, there's hundreds of thousands of dollars, at least in every single project, right, that we have to fund. Every single lender, every single investor is looking and analyzing the experience that we have, right? And so I think what you're saying is for those who are interested in becoming an active investor, that is really, really important. It does take steps, right? You're going to be partnering with a lot of people. I mean, sometimes you can get a syndication done, but sometimes that might take 3 or 4 or 5 partners to get into that first syndication, right? With one of those having some experience. And so I love what you're saying on, hey, the joint venture just worked for me, right? I mean, and that works also for a specific type of investor.
Yeah. So, and I think they see the world differently. Because I'll be honest with you, Michael, I don't want to partner with everybody. Right. And yep. I don't like the concept of, oh yeah, just wire the money. Like, I left corporate America for a reason. And a big part of the reason was I wasn't excited about returning maximum value to shareholders. I wasn't excited about having to do what was best for the bottom line at every turn. That didn't connect for me anymore, because I got the opportunity to lay people off 2 years in a row. And we made 30% profit margin. So how do those two things go together? They didn't for me. And so when I realized that, they didn't make me do it, but I chose to actually follow through and lay people off, I had a reckoning, and I needed to do something different. And so, anything for me where profit is the end all be all, it isn't exciting for me anymore. I want the investments to make an impact. I want to make money, but I don't want to have to look somebody in the face and argue with them about why this is the right answer, when they're just solely focused on how can I maximize my return.
Well, I love it. Great conversations. One of the things that I want to get into here before we start wrapping up, right, is you're the host of this podcast, Multifamily Missteps. You're doing a lot and you're hearing a lot. I'd love to hear kind of your perspective going off of that. What are some of the top, let's call it 2 or 3 missteps that you see multifamily investors making? and
Yeah, I think
also how to avoid them.
yeah, the first one is self-educating. Self-education is not the answer. It's the most inefficient and ineffective way to get your base knowledge. And while you should listen to podcasts, while you should go to conferences, while you should do all those things, if you don't have an end-to-end system for running your business, if you don't have a framework, then you are setting yourself up for failure. I think a lot of people are just trying to eat the elephant a bite at a time, but they don't even know the parts and pieces of what it takes to make the full dish. And what happens is you get the ball and you don't know what to do with it. You don't know which goal you're supposed to put it in. And then you pull other people's money in, and now it's a blind leading the blind, and everybody's pretending that they know, but they don't.
Yep.
And then somebody like me comes along, and I'm a wolf. If you're not in my pack, I'm going to take advantage of your lack of knowledge, because that's the world that we live in. It's real estate is a zero-sum game. If I make money and I'm buying something from you, then you potentially lost. There's only pluses and minuses on that HUD sheet. So it's really, really important that you get that base knowledge, and then you supplement and augment from the other sources through your continuing education. That's the one that I see the most, where I'm going to save whatever the number is, 5,000, 20,000, 50,000. I'm going to save that money and just figure it out on my own. But you're not taking into account your time, and you're not taking into account not knowing what you don't know, because you don't have a frame to actually connect the pieces together. I think the next thing that I see is a big misstep is just undercapitalizing. So I'm going to do all that I can with what I have, and I don't have any reserves on the back end. And so, it's funny, people talk about no money. And so I think no money strategies are for people who have a lot of money, right? Because inherently, when you buy a deal that's no money, the person that sold it to you was in a pinch. And that pinch means that there's something wrong with the property. And if you don't have money to take care of the thing that's wrong with the property, then the property won't ever get fixed, which means that you won't make money. And so there's all these semantics and all this great marketing, and it's a lot of empty promises that I see in the marketplace, which makes me really sad, because I see people who are pursuing generational wealth and they're just finding debt. And I want to put an end to that. And so I'm not your favorite guru, your syndication guru's favorite podcast guest, because I'd say something that's counter to the message. And I'm also not the favorite guest for people who have bought into this concept that they don't have to have any money or any experience or any real talent in order to be successful in this business. Michael, you talked about a really big loan, right? And in order to successfully navigate that and manage that, you got to be able to run a business. And so it's really difficult for me to see people who are in their W-2, haven't actually run a business outside of, maybe selling candy when they were in high school, think that they can go navigate and run these multi-million-dollar businesses and do it successfully. They end up in a really precarious situation, and sometimes people get hurt really bad. And I want people to really understand what they're getting themselves into. And I like to illustrate it this way, and I don't mean to go on a rant, but I'm really passionate about this. So, Michael, I know you're doing well, and I know you had some exits recently. So I know you had a liquidation event, and you might be looking for a place to put that capital. So look, man, I'm starting my MMA career. All right. And my first fight is going to be with Conor McGregor. And I can give you a 15% return on your money. It's 6 months out. So I need $500,000, right? It's 6 months out. We'll do the fight. And the way that I'm going to win this fight with Conor is I'm going to listen to podcasts, I'm going to read books, and I'm going to watch videos on YouTube. I don't have anybody looking over my shoulder. But look, man, I probably outweigh the guy by 100 pounds. And I've watched all these videos, and I've seen what other people have done. So I've got the wire instructions at the ready. If you just give me your email address, I'll send them over to you. And oh, by the way, if I lose, I don't get any of the money back that I put into this, but upside is 15% in 6 months. So, it's a 30% IRR, I think. So where should I send these wire instructions?
I love it. I love it.
Where do you want me to send them? You don't want them?
Jerome, you're maybe the only person I might send those wire instructions to. No, I'm just kidding. No, obviously no one's going to send those, right? I mean, you're going up against one of the great MMA fighters with no experience. And like you said, I love what you were illustrating. Hey, I watched a lot of YouTube videos and podcasts.
Well, I mean, but just it's 15% upside. I mean, people don't understand how difficult it is to operate. Yep. Right. And
I love it. That was an awesome example.
It's borderline disrespectful for the folks who are actually fighting the fight, because this is really tough, contrary to what your favorite guru will tell you, so that you send them a $30,000 check.
Yeah. That was a perfect illustration of exactly, some of the things that are happening, especially right now. One of the things people don't understand, right, is we're definitely booming right now. And our economy is a boom bust economy. Right. And you see this all the time as I'm not trying to predict when we're going to go down, because I don't necessarily know, but I can tell you with 100% certainty that we will come down at some point. Right. I mean, and so what you have is in these boom economies, everybody gets focused on give me as much as you can, give me as much as you can. Everything starts to feel like it's risk free. Right. I mean, I remember back in 2008, I had a friend who was like, oh yeah, I'm going to start buying houses because houses never go down in value. Right. And it was like, that was like a year before the big crash happened or whatever. Right. And that's kind of some of the feeling that I feel like a lot of these sponsors are taking right now is like, hey, just give me your money, because it never goes down. It's because they've been saved for the last 2-3 years. Right. Cap rates continue to go down, rents continue to go up, and they're not really focused on, hey, at some point there is going to be a downside, and you need to understand that, and you need to be preparing for that from day one, so that you don't end up paying Jerome Myers all your money to go fight Conor McGregor, right? I mean, that's the kind of scenario that people need to be thinking about and understand right now. Because if you wait to think about, well, what's going to happen if things take a downturn or things don't go as well as expected, it's too late at that point. Like if you wait until that already happens, you've missed the boat.
And the thing that most people don't get is just you making a decision in 2021, you might not find out that it was a poor choice until 2026 because of the way that this market is set up. And it's just terrifying for me to see people who don't actually understand what's happening to be deploying hundreds of thousands or millions of dollars against a business plan that has no actual opportunity at being successful.
Yeah, no, I hear you. Well, Jerome, I want to ask you one last question before we get into the last two questions that we ask all of our guests. Getting to this point in your life, in your career, in your, we're talking about the red pill and balance and, a centered life. What has been just one thing for me? What's been probably one of, if not the most difficult thing to overcome to get to where you are today?
Man, it's interesting because I think about where I am, and it was like, if I would have gotten help early on in my journey, I'd probably be 3 or 4 times the size I am in business. I think probably the most difficult thing for me is just my own ego, right? I went to engineering school, I got a business degree, so I think I'm pretty smart, right? And so I can figure it out, and all the information's free, right? So you just go get it and you put it together, and it's totally idiotic, right? Because you're saying that I know this better than anybody else who has done it, and I can spend my time doing it better than a person who actually has experience.
Yep.
And I've just been in the way of me growing so many different times it's embarrassing. I and it, it's disappointing when I have this moment of reflection because you asked this amazing question. Because there's so many folks out there who are like, oh, well, I'm doing the do. If you haven't actually sought counsel from a person who has the expertise at the thing that you want to do, you're doing yourself and anybody who's following behind you a disservice.
Agreed. That was fantastic. I really appreciate you sharing that with us because those are difficult questions. We all experience, we all have to overcome the obstacles. We're experiencing failures. And so to hear kind of a mindset of someone who is right here, and maybe a lot of people listening are right here and they're trying to get it to where maybe you are, Jerome. It's good to know and hear that, you and I and all these other people on podcasts and up on stage at conferences, we're all real people that have made real mistakes or have real regrets or would have, should have, could have. And those are the things that I feel like most often are the things that need to get passed on. Right. I mean, it's easy to go up and talk about, hey, look how successful I am. And we've grown 20x over the last 4 years and XYZ. And those are all awesome, right? Those build credibility and there's a time and place for all of those. I agree. But when you're talking with a lot of people who are interested in getting into real estate investing, I think the most important questions that we can answer and that will benefit others are going to be, hey, let's talk about some of the failures. Let's talk about, and how'd you overcome them? Right. Let's talk about the things that you would have done differently. So thank you for sharing that with us. But Jerome, we're going to wrap up. We have 2 questions that we ask every single guest who comes on this show. And are you ready for them?
Absolutely. Let's do it.
Perfect. So Jerome, what is the best business advice you were ever given?
Figure out digital marketing.
I love it. And why do you say that?
If you didn't figure it out before COVID, you had no business. And the reach that the internet gives people is second to none. I've literally changed my entire network through LinkedIn and the people that I've met there. And simply by using content-based marketing and thought leadership, I've been able to create a community of people who, have changed me knowing one millionaire when I got into the business to the majority of people I talk to having 7, 8, and 9-figure net worths.
That is phenomenal. In case anybody is wondering, the way that I found Jerome was through LinkedIn, right? So what he's saying and the content that he was posting, right? That's how him and I hooked up. I went on LinkedIn, we connected. I don't even remember how, if it was me or you or one or the other.
Doesn't matter.
Next thing I know, we're connected. I'm seeing everything that Jerome is posting and talking about. And I think, man, this guy has a lot of good content. I'm loving everything from the personal stuff to the business stuff. This is somebody who I want on my show. And that's how we hooked up. So awesome. I love that. And that's great advice, especially for some of us. I mean, you're talking about coming from a civil engineering background. This is something that's kind of hard for me too. I come from an accounting background, or I'm a CPA by trade. Accountants aren't necessarily known to be the most digital marketing savvy people on planet Earth, right? And I'm no exception, but I love that advice. So the second question, Jerome, what real estate investing advice would you give other business owners or business executives?
You don't have to get Moby Dick on your first fishing expedition. It's very okay to get some tuna in the boat, come back to shore, lay it out so everybody sees that you did it and your tuna's making money, right? So you lay out, let people know what your returns were. And if people see that, they want to go out with you the next time. And so maybe you got a bigger boat, more people, maybe you get some swordfish the next time and come back. And then maybe you do some shark hunting and then maybe you do the whale hunting. But this whole concept that you just need to go get Moby Dick the first go around, I think is hogwash. I think it's hogwash.
I love it. Well, that's great advice. Jerome, thank you for being on the show. Jerome, how can people connect with you or find you?
Yeah, I think the best place is to go to jeromemyers.co, and there you can get access to all the different things that we have going on. But the thing that I think is most interesting is our 4-step guide to get into multifamily investing. I think it gives a unique perspective on why we do things the way we do, and an opportunity for you to go into conversations if you're new to the business a little more educated so that you don't get the wool pulled over your eyes.
Love it. And we will definitely have a link to that in our show notes. Jerome, thank you again for coming and appreciate all your insight.
Thank you for having me, Michael. This has been outstanding.
Thank you for listening to the Executive Real Estate Investing Show. Ready to learn more? Go to executivereishow.com for more episodes and resources to help you create generational wealth through real estate investing. That's executivereishow.com.